sometimes it's just unbelievable. The stock market is dropping just like I told you it would, and the gold market is rallying just like I told you it would. Unbelievable. And of course, what's even more unbelievable is this incredible disclaimer here, which you should have memorized by now, if not tattooed on the forehead of your children. Now, what's happening? Stock market down, just as I predicted. We're seeing here the S&P, the broadest market index that we've got, under pressure. We've dropped from about 2490 to 2420, so that's no big deal. But look for it to get to 2410 and then support down around 2350 and then 2330. Look for this market to go several percent lower. Look at this. In the box, the negative energy is higher now than the positive energy. The red line is above the green line, showing more downside pressure than upside pressure. Kind of falls into the duh category, but still. Nasdaq cracked down hard on Thursday, did stabilize on Friday, but also no solace here. No place to run to in the Nasdaq. Seasonality, bam, bearish. Look at that. We've broken, and that means that when seasonality is bearish, I like to hunker down. All my long positions now will only be 0.5% of my trading equity. So small. I don't want to risk a lot of money anymore. Now, the seasonality that we're talking about is, let's look at the blue line. Looks like it should go through to the second or third week of September. We talked about this a lot last week, so I won't talk about it much this week. But still, there's still plenty of time. We probably got 3-4 more weeks to go on the downside, so get used to it. Get hedged. Get ready. Yield curve not doing us any good, but finally in September, it's going to start to be a bullish factor in the market. Asset allocation, money is flowing out of the stock market. It's going into the bond market. You should be long bonds, short stocks. That's the place to be. I'm pounding the table. Market risk indicator fell off the edge of the table. Look at that thing. Really, that is a hammering. And what that tells us is that market participants don't want risk. They're hunkering down. They're saying, I give up. I don't want to do anything frisky here. Instead, I want to be boring. I want to be in utilities and consumer staples and really boring stocks like that. But you know what? Those sectors are rallying strongly. Global shares also under pressure on heavy volume, so no safe haven there. But you can see, as I just said, bonds are rallying strongly. Look like we're going to sniff out those old highs at 128 and change, and the purple predictor is leading to the upside. So look for bonds to do better in the coming week. People are going to go to bonds as a safe haven over the stock market drop. Bond key factors, the most important one is the blue line. That's the German 10-year yield. But notice that the CRB also hooked down, and that's supporting lower interest rates. The dollar, if interest rates are down, then wait a minute, shouldn't the dollar be down? Well, it started to crack late in the week, but you can see this is what's called a flag formation. And I think we're going to break it to the downside probably on Monday, and that would be a great signal to go short the dollar. Short the dollar, look for a resumption of this big bear market. Hey, how do I know it's a bear market? Because the chart starts in the upper left and ends in the lower right, the most classic definition of a bear market. Well, if the dollar's going to crack down, then that's going to help gold even more. Last week, as you know, for weeks now, after my special seminar that I hope you attended, I've been pounding the table telling you that gold was going to skyrocket, that gold has the best seasonality in August and September. This is the time to be long gold, and we are long gold in our fully paid up member section. We've got lots of gold shares in there. Now, I also told you last week that the market would sniff out those highs at around 1,300. Not only did it sniff them out, it broke through, but closed the week below 1,300. No biggie. It's kind of like the D-Day invasion. We broke through, we landed on the beach, got up to 1307, something like that. The Germans beat us back off the beach. We're going to go do it again, and finally it's going to break and start to close above the 1300 level. Heavy volume on this latest rally. That's confirming that this bull market is in place and will continue for weeks, going into the future. Get long gold, stay long gold. I've been pounding the table about this. Holy moly, you got to be long gold. Okay, now, however, having said that, only the bottom panel is bullish. You can see that the CRB has started to drift lower. The euro, let's just call it sideways, but our indicators not as bullish. But fully paid up members have access to some of our super tricky indicators, and they remain very bullish. And seasonality is very bullish. So I'm still looking for gold to move higher. Oil spiked up to, strongly on Friday. Once again, this is a gigantic mess. It's a sideways trading market. I don't want to be involved in that kind of stuff. All right, listen, freebies, you know what you should be doing. I don't need to tell you. You should be subscribing to Be With the Cool Kids in the fully paid up section. Check it out. Go to that website up at the top, exactly the way it's written, and sign up and be with the cool kids in the school cafeteria. All right, fully paid up members, hang in there for just a second. I'll be right with you with some really, really cool analysis.